Good afternoon, everyone. Today it is my extreme honor and pleasure to be meeting and speaking with Jeffrey Gundlach, the Bond King. I know that Oprah gets a Duke and Duchess, but we are fortunate enough today to have true royalty within the fixed income and global market space to share his insights in the capital markets for 2021 and beyond. Jeff, welcome to the Virtu MindShare event. And again, thank you very much from all of us at Virtu and the Virtu community for sharing your time with us today.
Thank you. Looking forward to it.
So many things have gone on in the past year, and it's impossible to really pin anything down to a specific happening, given how busy just the last few months have been. I feel like today was a bit of a respite from the insanity that we've seen for the past 9 months or so. But given the fact that we are in a world where we have the Treasury issuing and the Fed buying all of this debt on a monthly basis of roughly 120 billion or so, and that buying seems to be moving on into the foreseeable future, do you see any risk in that?
Well, the risk always is when you embark on extraordinary programs is how you extricate yourself from the consequences of continuing those programs in perpetuity, because what's going on right now is highly unusual. We have so much issuance of Treasury debt, and nobody's buying it really except for the Federal Reserve, or I guess technically they're lending the money, so it can be bought. Foreigners have been selling Treasury bonds for years, and that selling has accelerated in the past 12 months. Retail doesn't really have, domestic investors don't really have any growth in their Treasury bond holdings, and so it's all down to the Fed. And with the amount of bonds that are being issued, which is in the many trillions of dollars, interest rates would be biased to the upside for sure, because one of the consequences of all of this, or the intended consequences of all of this debt issuance, is to prop up the economy and also to promote inflation. And with the Treasury rates as low as they are, most of our indicators suggest that when you look at the fundamentals that all of this bond issuance has helped support, that interest rates on the 10-year Treasury as a benchmark should be at 3% right now. We look at a lot of things to give us a signpost where the 10-year Treasury should be. One of my favorite ones that's actually become quite popular in the industry is the ratio of the price of copper to the price of gold. And since copper has been so strong, and since the summer gold has actually gone down, the copper gold ratio had been diverging very substantially from the 10-year Treasury yields, particularly when it was down there at 1% and even a little bit lower. Copper gold suggests that the 10-year Treasury should be at 3%. So do many other indicators like the PMI surveys and measures of GDP. Nominal GDP is way out of whack with where rates are. So not surprisingly, Treasury rates have been rising, but not in an impulsive sort of a way. There was a little bit of a moment there in February, but they've been rising in a fairly controlled fashion, and I attribute that to the Federal Reserve's buying of the bonds. The question becomes, what are we going to do with all of these bonds if we ever go back into a market-based interest rate price setting? And the obvious answer is the interest rates would go a lot higher, particularly because the Federal Reserve has been transparent more than almost ever in their transparency, that they're completely unperturbed by the rise in interest rates that's happened since about a year ago. And so when are they going to get perturbed is anybody's guess, but they like having, I believe, and this is an unstated policy, they like having the yield across the Treasury curve being negative on a real basis.
Right.
So it's a way of slowing down the debt problem. But the debt problem is getting to be almost hilarious when we think about what we used to call a troubling deficit, when it was 3 or 4% of GDP. The last 12 months, the official deficit is 16.5% of GDP. And as I've repeatedly stated publicly, that's a phony number. The deficit does not include some supposedly one-off items like defense spending on wars that are deemed to be temporary, but they're never temporary, on disaster relief, and I'm sure parts of the stimulus packages are considered non-recurring as well, although they seem to be recurring. So when you add that together, the actual growth in the national debt over the past 12 months is a staggering 23% of GDP. And a statistic that I like to reference, but nobody else ever talks about, is that our government spending right now at the federal level is a little bit over $8 trillion per year, which is kind of shocking because that in of itself is almost 40% of our economy, it's government spending. And yet 57% of that spending is borrowed money. So we have what looks a lot like a third world country that we're almost willingly turning ourselves into. And that's kind of the long-term risk and consequence of all this. It's characterized by crumbling infrastructure. It's characterized by massive wealth inequality. It's now being characterized by something very close to money printing. And yet at the same time, we have one thing no third world country that I'm aware of has ever had. We have massive amount of people that want to come and immigrate into our country. And I don't think anybody wants to immigrate into, sub-Saharan Africa or things like this, but we have all these people coming, and it's because our policies encourage them to come. So we've got ourselves in many ways in the United States in vicious circles. We have vicious circles of deficits. We have vicious circles of artificial economic growth that's completely non-sustainable, yet we're doing it what seems to be almost on a permanent basis. And how do we unwind all of this? And I get asked that question a lot, and the answer is, and I'm going to be blunt about it, you either have to restructure, which is a gentle word for default, on the $163 nearly trillion of unfunded liabilities in the United States, which is 775% of GDP. So if we wanted to actually pay that back in today's dollars, we would be giving away our economy like 10% of it for almost 80 years in debt repayment, which is of course completely politically non-feasible. So you might have to inflate it away. Or, and I think the third area they don't talk much about is you might need a new system, essentially. You might need a different sort of economic program that gets bought into, because as we try to work our way through the existing paradigms of our economic system, I think it's not an extreme statement to say they're not working. And when you get to a certain a level of brokenness, which we have in the bond market with issuance versus inflation versus the deficit spending versus all of these further spending programs that we really sort of need on an infrastructure basis that we're not even doing, as presented in the so-called upcoming infrastructure package. Much of it is not true infrastructure. These are the real consequences. And I believe that the next, it might just be me, but I think almost everybody will agree with me that the rate of change of kind of how we're going in terms of morphing societally, economically, and governmentally is accelerating. The pace is accelerating. It's getting to the point where it's getting sort of dizzying. You said that we seem to have a little calm today. I agree with you. There's something weird. It feels a little better today. I don't know what it is about today. Maybe it's because we've stopped having medical professionals in the COVID situation saying that they have an impending sense of doom. And instead, the mood on the COVID thing seems to have shifted just very recently to one of something approaching optimism, even. Yeah. So that's nice in the short term, but in the intermediate term, it might encourage us to let go of the tiger's tail. And what I mean by that is all of this economic growth that is promoting huge increases in consumer spending and the housing market prices and all that. If we curtail that, it's going to get very bumpy very quickly. And I think that's the real in the more near term, that's the real consequence and risk of all these behaviors.
Jeff, you've outlined so many great points in just one simple question. And it's hard to imagine in listening to your answer that volatility, which, as you know better than most, closed today below 18, that there is a sustainable level of that calmness that you and I both agreed we're witnessing today. With 30s or with 10s at 3%, with 30s then correspondingly maybe at 4.25%. Is that the rate that we start attracting non-government buyers, where we start to see those corporations and insurance companies come back? I understand that it's also subject to the level of the dollar, and that's something that we haven't touched upon yet. But do you see the VIX? And I know that in some of your published remarks within the past few months, you've stated that it's not out of the question entirely to see a VIX approach something like 100 within the next 2 years. Has anything happened since you made some of those comments to today, where we agree we're in a sense of calm, that would change your mind?
No, not at all. In fact, quite the opposite. What I think the biggest point, if we really want to zoom out to really big themes, one of them is that we have exited the minimum volatility phase that we enjoyed in 2016 into 2017. In 2017, we had the least volatility in the equity market, really of pretty much any year in recorded history. The VIX almost never went below 10 prior to 2017, and it had dozens of days in 2017 where it was below 10. And there became a narrative that was consensus and repeated almost daily in financial media that the VIX would never rise again. Never is a very interesting word in the financial business because it's a synonym for imminent. When you hear people say never, it generally means that it's imminent. And I talked about in the summer of 2017 that I think we'll probably look back at 2017 as a very unusual year and the end of an era of declining volatility that was accomplished from the manipulation by the Federal Reserve primarily. And what happened after I said that, I said, I think the VIX will quickly go above 15. And I was mocked when I said that on national TV because the narrative had developed so absurdly that the idea was that there's now a structural change in the market that has created a permanently lower plateau in volatility. And I thought, actually, the opposite's about to happen. We're going to enter an era of higher highs in volatility, sort of on a multi-year forward-looking basis. And of course, that happened. I mean, the VIX went up to like 80 or something like that in the meltdown in the pandemic introduction. But I think that that's just going to continue because the grotesque mutations of the government's actions are not just the Federal Reserve anymore. It's also, the Treasury Department, the tax policy, the whole thing. And as I say, once we sort of try to move back to what we think is normalcy, I think the volatility is going to explode to the upside. And we've seen a lot of strange financial market action too in the past year. We saw the price of oil go to negative $40 a barrel on a contract, closeout date because the people had nowhere to store the oil. And so if you don't know where to store the oil, it costs more to store the oil than the price that you would sell it at. So you have to sell it at a loss of $40 a barrel, incredible stuff. And then we saw tremendous retail involvement come into the stock market, which I believe just doesn't stop. It's been coming in on government stimulus checks, obviously, and unemployment benefits and people being locked down and not being able to go to the racetrack, at least until recently, or at the casino. And we saw true casino type activity in many parts of the stock market with penny stocks, having incredible sponsorship, all kinds of micro slices of options and all of this, record activity in the options market on the call side. And then we saw, of course, GameStop, where they shorted more than existed. And that got run again because of government money, because people had this playing with the house's money mentality, the government money. A lot of people think, well, so what if I lose half of it? I could make a lot of money on momentum trade, and all this is going on. And you start to see what happens when these incredible momentum movements, for whatever reason, peter out. And we saw that recently again, just in the last week or so with Archegos, if I'm pronouncing it correctly, the hedge fund. And this has happened repeatedly in my career, where you get speculative activity, and when it blows up, which is what happened with Archegos, because the stocks finally started to fall and they basically had so much leverage that they got wiped out. And what happens when a financial entity gets wiped out to excessive leverage, I've seen this movie so many times. The post-mortem is gosh, Bank X knew that they were lending money to it, but they had no idea that banks Y, Z, Q, H, and P were also doing it. And they didn't know they were doing it through the swaps market, where it's actually not, 1-to-1 leverage, it's 5-to-1 leverage. And so you don't need a 50% drop to wipe out Archegos. You only need, about a 20% drop. And then these stocks, of course, drop that in a couple of days and poof. So I think as we see repeated occurrences of these on greater and greater scale, it's just a sign of the times. So when the next rollover comes, and that would probably happen with either yields rising. I don't really think the Fed will let the 30-year get to 4% or the 10-year to the mid threes. I just think they won't have a tolerance for that. But I think that whatever happens is a catalyst for the market to roll over. There's a lot of momentum and bullish sentiment built up. And that is what's going to cause a waterfall of selling that will take the VIX. I'm going to be so bold to say above 100 for at least a crescendo of fear. As the next leg down, we'll have a very substantial unwind. And the book will probably be written again that, I didn't realize how much leverage there really was, because after all, the options markets and all this created an awful lot of leverage in the system. And we have another stimulus check that are sending out.
Right.
So you can probably ascribe this below 18 VIX in the short term to, again, the calming effects of the government's money spray. But they're going to have to stop it at some point or declare it permanent. If they declare it permanent, we've actually side-doored our way into universal basic income. We're pretty close to be able to declare that already, I would say.
Right. Jeff, again, you've touched upon critical current events, especially with Archegos and issues with their primes and family offices turned hedge funds, turned running up leverage ratios, and then, as you described, poof. And then we wonder why major banks are losing billions of dollars. Although we could say we're in a position where the banks are certainly better capitalized than they were, as we witnessed in 2007 and 2008. But with that, we at Virtu pride ourselves on being operationally excellent around market structure issues. We compete as a market maker, and we are LMM in some of your funds, and thrilled to be doing business with DoubleLine and looking to continue to grow and expand our relationship. But we have to know with certainty our ability to borrow in securities, or we have to know with absolute certainty our clearing costs, and we know what sort of leverage our primes are going to give us, or the clearing houses that we're dealing with. In the treasury market, and as you know as well as anyone, in 2014 we had the 12 minutes of fury, where we had this gamma trade that suddenly appeared in the OTC uncleared markets, and then all of a sudden on the listed bond futures we saw some bids, and then before you know it, the cash markets have become unhinged, and we see this complete collapse in yields and prices run, and then with 6 minutes later it just completely recoils back. And we as a firm were caught up in the middle of that because we had the data. We trade on most of the platforms, and we were able to sort of consolidate the data and hand that data off to the Fed and Treasury. In fact, Chairman Powell was a governor at the time, and we had a chance to spend some time with him and speak about Treasury market structure. At this time where we are issuing more and more debt, where the market participants are reliant really upon, where our government, where our people are reliant upon that debt issuance to be successful, do you have any concern at all about a debt auction maybe not going as well as hoped, with with fat tails and a lousy bid to cover beyond that, with really maybe a failed auction? Or do you think there really needs to be a regulatory look at changing market structure, not just in treasuries, but possibly in credit as well?
It's a big question. It's an interesting question too. I mean, we did have that February 26th 7-year auction that went down as one of the worst on record, and it caused a lot of consternation. We also, we've seen a lot of illiquidity a year ago. During the start of the pandemic, we had this incredible dislocation in the treasury market that rippled through the entire fixed income market. A lot of participants don't know that there were moments. They didn't last very long. They generally don't when they occur, but there were moments when there was a 5-point bid-ask spread for off-the-run 30-year treasuries. This sort of thing very rarely happens. There were moments when, because of the mass liquidation of the pandemic across risk sectors, there were moments when the bids for parts of the emerging market, fixed income market, were literally no bid, which means zero. You could not sell them. Your question's a big one. We often have liquidity issues and lack of transparency issues that lead to some of these dislocations. A bad auction is probably just due to the fact that the yield was too low. Although interestingly, the yields today are virtually identical to where they were February 26th. It's shocking how little they've changed. The 5-year's up 5 basis points, the 30-year treasury's up 1 basis point. The junk bond index, ETF JNK, is literally unchanged. So very little has happened. So it's weird that the market seems relaxed now at the yield level that it rejected February 26th, and yet there is no improved outlook for the inflation situation. I don't think anybody's looking for economic problems in the near term. Far from it. People are ramping up their GDP. But here's the point. I've seen regulators and market overseers talk a lot about a lot of things, and they're always investigating things and running committees, and nothing ever happens until such time as the big blowup occurs. I've been at this game for over 35 years, and I've never seen an example where the problem was correctly anticipated and the tough steps were taken to try to, let's say, fireproof the market. The regulators, the Fed, all of them basically have proven to me over 35 years that they're not interested in fireproofing. They're not interested in clearing the brush away from their property in Central California. They're more interested in playing fireman after the fire has already started. And so I think, unfortunately, if the issues that you're bringing up do materialize, and there's certainly reason to believe that they're becoming more frequent again with all of this grotesque behavior, I think we're going to experience some really big problem that measures to prevent such problems, will only be taken after a problem like that has already some sort of caused enough pain so that things happen. One thing that's interesting about all this stuff about liquidity and making the markets function better is over the past several months, we've done the opposite. And they let the SLR expire March 31st, the supplemental liquidity ratio. And all that does is create the potential for this problem to occur in a more high probability fashion. So we've done exactly the opposite in terms of, and also you mentioned the global financial crisis, where clearly there were all kinds of leverage problems then that weren't addressed in advance. The response to the global financial crisis was to reduce the balance sheet exposures of banks, essentially their leverage. And what that means is that the banks have proven to be less capable of being a shock absorber when there's volatility. That was one of the things that really helped during past recessions and bad bond markets, was dealers would be able to absorb the inventory of selling. And now they can't do that. And with the SLR going away, to the same extent, with the SLR going away, we've taken a back step to really some of the worst conditions relative to the banks being able to be shock absorbers. So I do think, again, I think we're in an era where we should expect weird things to happen politically, sociologically, governmentally, and ultimately that will be reflected through market volatility of unprecedented proportions.
Jeff, you've in the past, let's say, year or so, you have been fairly outspoken about your dislike for crypto, and recently that has changed. And obviously, we've all witnessed the run up since the end of December to numbers that I don't think anyone really would have predicted. And I know that we have, as discussed today, we'll be speaking with the Winklevoss twins and their company and how well they've actually done in getting involved in this. I'm not sure if you even call it an asset class, but this product that is definitely taking the market by storm. It seems like it's here to stay as some of the big names have thrown their weight behind it. Is this something that you are going to get involved with or already involved with at DoubleLine?
We decided to start to at least be capable of including crypto as a so-called asset class. We do stocks, bonds, commodities, currencies. Why not throw that in there? You're right that I was very bullish on Bitcoin for 2020. I do a webcast in January, early in the year, called Just Markets. And one of my highest conviction ideas was that Bitcoin would go up a lot in 2020. And I thought I was really shooting the moon. I said, I think Bitcoin was at 4,000 or 5,000 at the time. I said, I think it's going to go to above 15,000 this year. And what's ironic about that is I looked like an idiot for several months because it really didn't do anything. And then all of a sudden I looked like an idiot because it went way higher than that. And clearly that's another momentum market. And you're right in saying that some of the motivation for this is some big names. Paul Tudor Jones was one of the first to sort of say, I think that this actually has some investability, attractiveness to it. I think at the present moment, I'm looking at Bitcoin as the benchmark for crypto, as really the sign of a crack in animal spirits. For it to go to 60,000, you'll notice that it hasn't been able to go up lately. This is true of just about everything. That was, so many trends got extended during 2020. Last summer, we had the Super Six that were killing the entire S&P 500. They're actually not outperforming anymore. I mean, they're not exactly falling apart, but they're not making the gains. It's now the Russell 2000 that all of a sudden has exploded. I mean, you had one of the most extreme undervaluations of small cap versus mega cap on record back in the June to September period, and the entire thing got reversed in like 2 months. This is another sign that there is wild speculation in the markets. Bitcoin, if it were to start falling, it would probably do what it did in December of 2017 and early 2018 and fall, 2/3. I really think that that's likely to happen. That doesn't mean that it's not long-term viable, but the volatility there is so extreme that it just further corroborates my idea that we're in this sort of speculative market. But I think that Bitcoin it sure is tenacious. The support for it is not easily discouraged, and so I do think that it's interesting that Bitcoin has completely blown old money away, gold. Gold hasn't done anything. It's actually down since June or July of last year. And Bitcoin, of course, is up hundreds of percentage points. I think that gold will ultimately continue to serve as a value relative to inflationary fear. But Bitcoin in the near term clearly has outpaced that due to the wherewithal that's been provided to the small speculator in the government giveaway.
Jeff, you talked before about universal basic income, and obviously we're dealing with a brand new administration, and you're based in California, and you're seeing probably firsthand some of the issues related to immigration at the southern border. But do you see universal basic income and its potential rollout? I mean, you can almost argue that given how much the federal government has been already inside the pockets of many of our citizens, that we are somehow living in a UBI environment. But do you see a real UBI as being that quote unquote social security moment of the Biden administration as he is trying to achieve FDR-ness, or so I've been reading?
Yes, I am always amused by the fact that how the public's attitude has changed regarding government money giveaways really over the past 50 plus years now. We started government giveaways a long time ago. You talk about Social Security, that was started back in the FDR situation. And then we did Lyndon Johnson's welfare, which was UBI to a subset of the population, which I think is a very cynical way of doing things, basically buying people off for sort of subsistence living and taking away all of their opportunity and their children's opportunity. That's what I think welfare really did. And now we're expanding it. And I have to hand it to that. I never really thought that we would do UBI so blatantly in plain sight, which is what we're doing right now, at least temporarily, on a side door mechanism. I mean, we're basically saying, okay, we're gonna tell you that this is temporary. It's a one-time deal. A lot of people get it. I mean, a lot of people are getting money from the government. The most recent stimulus, I mean, people that make $150,000 and have 3 kids under the age of 6 or under, they're getting $13,600 from the government per year. And 3 days after that was proposed and passed and signed by President Biden, Senator Schumer, 3 days later, advocated these should be made permanent. So it's pretty in plain sight that UBI is coming, but they've done it in a very clever way by exploding the budget deficit, by making it absurdly high versus GDP, and seemingly, as far as the eye can see, they perhaps intentionally will create with high probability a moment where people say, well, this is now so absurd that we can't really ever pay it back. So we could find ourselves forced through this already side door UBI to go into more old school, historical, through the millennia money printing. And there's been plenty of examples of money printing in the 20th century, plenty of them. And it's remarkable how quickly they lead to societal dislocation, which always, as far as my research shows, ends the same way. And that is that the people who were middle class become impoverished. The people who were impoverished go into a starvation mode. And the people that run the UBI or money printing become very wealthy. Well, if we just step back, and I know it hasn't been a direct money printing mechanism, if we step back, I think it's crystal clear that the people that 2 years ago were very wealthy have become ridiculously wealthy. Obviously, the Super 6 CEOs, and I mean the FANGs plus Microsoft and so on, I mean, their net worth has exploded, and there's been plenty of talk about this. It's probably because, in a certain sense, we're doing UBI. So we've already got to have evidence that the same historical experiences that occurred in the Weimar Republic, in Yugoslavia, in Bulgaria, in Venezuela, in France, in the late 1780s, they always lead to the same thing, which is greater wealth inequality, even though the programs on the surface are designed to eliminate it. And that's what leads to the ultimate reorganization of society, which I strongly believe is the only way that the United States is really going to get back to a level place to stand. And I've been talking about this for years. Back in 2012, I announced to people, I know I've been talking about the need to reorganize. I have good news for you. The path to that is on hold for now because of the compounding curves of the social security system, the welfare system, and the like. We're in a fairly good place. And I said, until around 2019 or so. What happened? 2019, boom. And if you think that what's happening now is weird, you ain't seen nothing yet. Because this train of the insane is picking up steam seemingly on a daily basis. And we are going to end up reorganizing, which is painful while you're doing it, but it actually leads to a framework through which the society can actually prosper and go into a phase of great opportunity and optimism.
Well, Jeff, I think that's probably a perfect spot to end it. I want to thank you for your time today, for your direct answers, and as someone from the industry as well, it is an honor to have spent the last 45 minutes with you. And thank you so much for making Virtu 2021 MindShare an important event for all of us. So thank you very much.
Well, thank you so much. You're too kind, John. I've really enjoyed it today. Good luck for everybody for 2021.
Thank you, sir.